Hey, everybody. Thanks for joining us. I am David Russell. You guys probably know who I am, but my friend with me today is Zach Wesley, and he is my friend because we've known each other a little over 2 years. And Zach, I called first to do this podcast here because Zach is in the banking world. I'm going to let him introduce himself a little bit, but I'll just tell a short little story that there was a time when I had a financial need and I wasn't quite sure how to approach it. And I went and talked to Zach and he gave me some great advice and it really helped me in the sense that I was able to get, funding for things that I needed and in a way that I didn't know about beforehand. So Zach, why don't you introduce yourself and, just tell people who you are, what you do in the world and anything else that might be exciting or relevant.
Sounds good. Thanks, David. Well, my name is Zach Wesley, and I have been, I guess the majority of my adult life in banking. Spent over 11 years in banking, with over 7 years of that within the commercial lending environment. Not necessarily directly lending. I was a lender for approximately, I think, 5 years, and have spent time as an underwriter, and in my current role, which is a little more commercial credit risk type position. It's kind of hard to explain, and it would really bore you to tears if I were to tell you exactly what I did on a daily basis. But it's a nuanced world in the commercial lending world, and hopefully today we can cover some topics that I think will provide some clarity for those who have not pursued business loans. Now, obviously, the things that we'll talk about today don't guarantee financing or anything like that, but they will hopefully at least provide you with some better understanding about what a lot of banks are going to be looking for when you go to request a loan.
Right. Right.
And so if you want, I can just kind of jump into it here and
yeah, I'm here to learn as much as anyone who watches this.
Absolutely. And I'm going to keep it pretty broad and general, because we can get way down into the weeds on a lot of this stuff, and it can get very confusing and convoluted quickly, which is why we have bankers, is because they are essentially required to be somewhat creative at times and required to kind of think outside the box.
Right. Because I think that too is why, just like we're talking, I think just off the top is just encourage people, if you are a business owner and you're thinking about lending or you have a need for lending, is to go talk to somebody in commercial lending, go talk to a banker, and the conversation can't hurt, and they're there, they really are, they're there to help.
Yeah. And that's honestly, that's what it is. When you think about the entire intent and purpose of a bank, it is, of your community banks, they are there to help build and facilitate the communities in which they operate in, whether that is, through financing or deposit relationships. When you think about a bank as a entity that loans money out, what does that money do? It allows you to grow and expand your business, which helps the overall economy of that community in which they operate. And that is the purpose. I mean, when you boil it right down to the very basics of what that bank should be, it is a community builder. And that's just the main driver for it.
Right.
So, when we talk about small businesses, and I'm not going to lie you or sugarcoat it in any way, is that it can be difficult for a small business to obtain a loan. And that's for a whole bunch of different reasons. That's not necessarily because they're not credit worthy, or they don't have, have the credentials that, a large business borrower would have. It's simply because there's some lack of exposure, I think, that sometimes small business owners may have to what's required of them to get a loan, and that the entire process can be daunting. And that's why it's really important, when selecting that, the bank and the banker that you're going to work with, that they be willing to explain things and work with you and cooperate, at times even hold your hand. It's a part of the process. A good banker will be there to communicate with you openly and honestly and truthfully, and do everything that they can within their power to, help facilitate your success as a business owner or individual.
Is it fair to say that it's sort of like like your own, like a lot of us are familiar with personal loans, like we've gotten a car loan or a signature loan or a loan for our house. And I think most people know that, through life when you're young, it's like you've got to kind of build this. I don't like the word worthy because some people might be completely worthy, but kind of like you said, they haven't shown themselves. They haven't proven themselves. So a stranger doesn't know if I give you $100, are you actually going to give it back to me or not?
Right.
And so we talk about your credit score and things like that. I don't even know. Are there credit scores in commercial lending? Like, does a business itself get a credit score, or is there another way that's kind of done?
They can. A business can has a there's yeah, it's not really going to, for smaller businesses, it's going to be some of your larger, national level businesses are going to be more easily identified as having it's kind of like a business credit score
Right.
that you use for evaluating them. But for your smaller businesses, even businesses that may be up to even, $10 million in gross revenues would probably not have a business credit profile.
Right.
So
There is this
way
kind of
that
path for proving yourself, even though it may not be a credit score. There's another. It may look different, but there's kind of that path that you got to go through, sort of.
it absolutely does, and that's what most banks, I say actually every bank, will have some kind of commercial underwriting department that will review and assess that individual borrower and that business based on their historical performance. And the way they do that is, they typically review tax returns and all that kind of good stuff. They look at the guarantor, the individual that is the primary owner of that business, and they do review the credit score related to that. That's what I was actually one of the, I guess, biggest talking points today that I was going to try to do here would help people be in the best position possible when they go in to apply for a business loan. And this is going to be kind of centered around an old banking adage called the 5 C's of credit. I've given talks on this for some small business things with Arkansas Tech University in Russellville, related to securing financing and helping small business owners understand what banks are looking for. And so when we talk about the 5 C's of credit, we've got these 5 C's are character, capacity, collateral, capital, and conditions.
Okay.
All right.
Yep.
So that first thing, the character that we talk about there with character is really first and foremost assessed by the credit score. The credit score being the biggest determinant of that. Sorry.
Yeah.
As this put it frank, you're going to need a good credit report and a good credit score. Notice I said credit report and score, because most banks will have a minimum score of 640 or somewhere around there for what they are allowed to lend to, based
Right.
on that kind of predetermined metric based on your credit score. But hitting that mark doesn't necessarily mean that you can't be disqualified based on other factors that are present on the report. And so one of the best things you can do as a consumer, and a lot of banks have this, that, most people do have checking accounts, right?
Right. Yep.
Well, there are a lot of times you can have, most banks will offer a free credit report service through having a checking account, depending on the level or tier of checking account that you may have. It's kind of one of those add-on bonus perks that you can pay for, usually at a relatively minimal monthly charge for those kind of deals. So I can't speak to every bank and how they do that,
Right.
but I know, through my employer, I have one so that I can monitor my own personal credit, and it's at a very manageable, low monthly cost.
Right.
And so by being able to do that, I can keep track of it. I get alerts on that, email alerts, and it's very handy. Even if you have your credit pulled, it will tell you, hey, you've got an alert on your account, just so you know. So it also helps with fraud protection and all that kind of stuff too. And so, the reason I say that you can have a credit score that may meet the minimum mark, that there are other things that can exclude you, such as serious delinquencies. If you have 30, 60, 90-day late payments showing up on your credit report that took place, within a relatively recent period of time, let's say it's just one or two, that could still be frowned upon,
Yeah.
if you will.
Kind of a red flag to make them more cautious about, okay, let's dig a little deeper. Do I want to do I want to lend money to this person who's been late a couple of times in the last couple of months?
Right. Or is there a trend? Has there been a history of this on a lot of older accounts? And how do that tell? It can tell you a lot about the borrower with how they handle adversity, how they approach things, related to their financial situation.
Right.
And it doesn't mean that they're bad people or anything like that, but it tells you about that character related to borrowing and the view of the financial institution relationship.
Right.
There are also things like, one of the biggest things that I see, David, are collections. Okay, if I had $1 for every time that I had seen a $74 medical collection show up and ruin somebody's credit score, I would be at least $100 richer. Just being honest with you, those are the kind of things that really can sneak up on consumers or borrowers. That's one of the biggest things that I say. Oftentimes, if you think about things like having a child, that's something that to me is been kind of a big deal, because I've got 3 kids that are 7 and under. That it's very easy for an epidural charge to not come from the hospital, but to actually come from the provider that's been there. And that epidural may be $400, but let's say you moved during a period of time, or that bill never actually made it to your house because they didn't get your address for whatever reason.
Or I've seen before too, where how this is a little rabbit trail for a second, but if you have medical insurance, a lot of times you'll get this bill from the medical provider that's for the full amount, and they also sent that bill to the insurance, and so you don't pay that first bill because it's going to insurance, so you kind of set it aside, and then insurance comes back later. But I've had this exact case happen in my past that you talked about, where all of a sudden I get this delinquency or a collections notice from, like you said, it was like $150 bill. And I'm like, what is going on? And I call the place, and they're like, well, yeah, we sent you a couple letters like 4 months ago. I'm like, well, yeah. I'm like, but this is 100% covered by my insurance, 100%. Yeah. Like, oh, well, we contacted your insurance, but they never replied. I'm like, you could have told me that. I mean, it's $100. I mean, it's not a big deal, but yeah, I see what you're saying, that stuff. So that's where good with that monitoring comes up, so that you can see if there's something flagged and try to handle it instead of letting it fester.
Absolutely, and that is one of the most common things that we see that does hurt credit score. That as far as like one of those things that would pretty easily be remedied if you just knew about it. But it can sneak up, and it can sneak up and bite you pretty fast. Right. Other things, too, like a bankruptcy. Like, bankruptcy, most banks, are going to have policies in place that, if you've had a bankruptcy within X number of years, you're not going to be able to procure a loan. And that's, just kind of one of those things that even if it's for a business purpose, if it's showing up on an individual's credit, report, if that business owner has that, then, you're still going to be, most of the time ineligible if it's taken place within the time frame that you're excluded from being able to apply for credit.
Right. Okay.
So that leads us into the second C here, which is going to be capacity. This is one of those things that I've heard said before, that cash flow is king.
Yeah.
Okay. Cash flow, the ability to repay the debt. And I'll talk a little bit more about this later, but to say the least, a bank just wants you to make your payments. That's how banks make money, is by you making your payments. If you don't make your payment, then the bank doesn't make any money. And that ultimately, it puts me out of a job if I'm the lender, and it, puts, if that happens enough, then obviously it creates, problems. So that capacity. So if you, basically kind of what I've got here is that, you're going to have the demonstrated capacity to repay that requested debt. It's most of the time banks are going to refer to this as cash flow, or really cash flow is kind of the biggest deal.
Wasn't this some of the problem and if you don't know, or correct me if I'm wrong, but wasn't this some of the problem in the 2008 housing crisis, that some of the loans, and maybe you don't know this, but some of the loans that were given were actually, it's like that window of cash flow was really probably smaller than it should have been, and put a lot of people where in a perfect world, they could have made the payments, but nobody lives in a perfect world, and there's always bumps, and there was no margin of error for that. That's my understanding. Again, that's a residential loan, so that may not be your area of expertise.
Well, no, I've definitely been around a little bit of that discussion, and just, from my understanding of being in the industry, that was a portion of the problem.
Portion,
yes.
yeah, not the total, yeah.
Yeah, as well as a bunch of other,
Crazy
I
stuff.
can't.
It's just crazy
A
stuff.
bunch of other issues that were taking place with
There are definitely issues.
how they were handling those mortgage bonds and bundling those inappropriately, if you will.
Right.
But that is a big part of it. Is a bank wants you to just pay your debt back. That is ultimately, at the end of the day, they want you to repay.
Right.
And I'll tell you this, for most banks, the way they have to look at this kind of thing is they're going to look at it from the business's capacity to repay.
Okay.
If the business is underperforming, or if it has historically not been a profitable business, it is hard for a bank to underwrite that from the primary source of repayment, which is from that business.
Right.
That is, if you're procuring a business loan, the business has to be able to repay it.
Right.
Now, with that said,
go ahead.
Oh, go ahead.
I think that speaks to the importance of keeping good books as a business owner.
Yes.
Because if you're operating with cash in pocket all the time, you don't have any kind of accounting ledger, whether that's paper, preferably probably software these days. That if you're not doing that, you can't prove your company's capacity to repay. You just can't prove it. You could tell them all day long till you're blue in the face, but without a paper trail to say, here's my ability and I can prove it to you, then yeah.
I know.
Okay.
Yep, that's exactly what it is. Is that when it comes down to it, you got to keep track of that stuff, and there has to be a demonstrated capacity to repay. And a lot of times banks, what they'll do is, if you've got a business borrower, they're going to probably require that business owner to be the guarantor, or to be that person to provide a supplemental income in the event that the business, has a downtime of cash flow for repaying that debt. So a lot of times, the banks will supplement that. It's kind of called a secondary source of repayment, and we could get into secondary, tertiary, sources of repayment, but most often it's going to look at that guarantor and say, okay, well, do we have, W-2 wages to back that up, or any other source of income? Maybe you've got rental properties, or, something like that, or retirement income, or just whatever. But, those kind of deals, we're going to look at that individual's capacity to help support that debt. Right. And it ends up, depending on the bank, depending on how the banks underwrite and the way they do it, is, they can sometimes maybe they look at that equally. It's just kind of dependent upon the bank that you're looking at.
Right.
Okay. So, and one of the biggest things too that's hard to understand, or I guess it's hard to convey as a banker, is that I understand that this requested loan allows you to go out and purchase a large piece of equipment that's going to cause your business to just skyrocket and blow up, and it's going to be great. But the problem is the banks will oftentimes have to underwrite to a worst case scenario to say, well, that if, let's just say, that business doesn't take off, and we have to look at it to say, can you support that payment right now doing exactly what you're doing?
It stayed the way it is right now. Yeah,
exactly. And I'll say that we're talking about a bank, just a standard bank loan. Now, there are programs through the SBA, through Small Business Administration, that do allow for the use of projections with that. It is a much more rigorous underwriting timeline for that, and it takes a lot longer. Now, it's a great way to go, though, for a lot of business owners, particularly if they've not been in business for 2 to 3+ years. That those kind of programs, that is what they are there for, is to essentially provide financing when banks can't do it, when they're just not allowed to do it through their normal lending platform, and they call that the credit elsewhere. Like, essentially, you can't get credit elsewhere.
Right.
And it's not because it's a bad deal or anything like that, but there are just certain check marks that your standard community banks have to follow, and that's government regulated. That is just kind of the way it is. And it's not that Not that the banker doesn't want to do it or doesn't think you're a stand-up person or anything like that. It's just there are regulations that do govern things, and we have to kind of you have to comply with those things.
You have to comply with it, right?
Yeah. It's a part of maintaining that FDIC insurability.
Right.
But programs through the SBA provide guarantees, and they do allow your banks to do certain things that they otherwise can't do.
Right.
So,
Awesome.
so with that will bring us to our third thing, which is the collateral. Our third C is collateral. So banks are going to need something to secure the loan. This is hopefully the third or tertiary source of repayment, which would be a liquidation of collateral, which is where a bank never wants to get to. Let me just say that outright. A bank never wants to reclaim anything that a person owns. And a good banker is going to know how to utilize or help you think through the different possibilities for the way to use what potential collateral you may have. Just to kind of talk about this, banks do have a hard time loaning money on small tools and small equipment. That can be very difficult. And to quickly talk about an alternative form of financing is that sometimes that can be done through the actual vendors themselves. The specific brand companies for those certain tools will actually provide you with financing to purchase some of that smaller equipment and tools that a bank may not necessarily be able to capture as collateral.
Okay.
Be willing to, if it's not within that bank's risk profile, to say, we want to be heavy in the small, machinery and equipment stuff, because some banks won't. There are also equipment financing companies that can finance, that specialize in financing equipment, much like your auto dealerships finance vehicles to you for 300 months, and 0% interest, for all this period of time. And
300 months. I don't even know what's the math on that. I mean, how many years is 300 months? That car's not going to be around in 300 months.
25. Yeah, no, it'd be crazy, but that's the kind of deal that some of those finance companies can make loans on those kind of things based on, and chances are they're probably going to pull your credit report and look at you as an individual to determine whether or not they can loan you the money for that.
Right.
Now, I obviously can't attest to all the terms and stipulations they frequently put on those kind of things, but there usually are some, additional fees and things that they do to help make sure that they capture some of that potential loss that may be sustained on the front end. So, so when it comes to things like that, another thing is like even contracts for jobs that may be out there. A bank can't really collateralize a piece of paper, even if you can walk in and say, like, look at all this work I have lined up and I really need to get this thing to get it done. It doesn't necessarily mean that the bank can make a loan against chances are the bank probably can't make a loan against that, that future timeline of work being performed.
Right. It's like trying to guarantee the check's in the mail. Well, my friend told me the check's in the mail, so can you loan me some money till it gets here? And it's like, I don't know that check's actually going to come through. And even if it doesn't, I have no legal power to go seek it out. Yeah.
Yeah.
I can see.
Absolutely. And that's the kind of deal is, it's really oftentimes very hard for a bank to be able to collateralize on those kind of things. Right. Most banks are looking for something that has to do with like a vehicle or even large equipment or machinery, something that does carry a longer term value. Those kind of things that don't depreciate overnight, or can't be carried off in a pocket, from, your garage or something like that. Those kind of things that do have a longer depreciable life. Real estate, that is usually, and I'll say this is the majority of community banks are going to be pretty heavily focused on real estate. Any real estate that an individual may own or a business may own is going to be viewed more favorably because real estate values don't tend to depreciate over time. And therefore, that provides an ongoing increase in that asset value as time goes on. And banks are allowed to finance for longer periods of time attached to those to real estate, basically.
Right.
Those kind of things, such as your home, any land that you may own, or, a rental property or whatever it is. Banks can loan for longer periods of time against that kind of thing. Now, they do have loan to value percentages, things that have to be calculated on, but a bank may be more comfortable with a heightened level of risk if they have a really low loan to value, or, for those kinds of things. Now, every bank is going to be different. I could tell you what one bank would do, for that kind of deal versus, 300 different variations of that with any other bank.
Right.
So.
But either way, they've got some policy or guidelines or whatever that they're following that could differ. So in that sense, while we're there, does that make it worth maybe talking to more than one bank? Like, just because a bank says, no, we don't think we can do it, I mean, the bank across the street might be able to do it.
Honestly, I would absolutely recommend that. David, I would, and this is coming from a banker myself, is that as a consumer, I'm going to shop. When I take my name badge off and I step out into the market, I'm going to shop the best that I can. Now, I'm not going to say that that's always going to be for the very best rate, or something like that. I'm going to shop. First thing I'm going to shop for is the banker. If that's me, I'm going to shop for the banker. I'm going to shop for the best potential product placement that they may have. And I'm going to talk a little bit more about that when we get into the consumer deal. Just because for individual loans, some banks may have totally different products that they offer that allow them to carve out a little bit of a niche. So I'm going to find the best possible banker that I can find, the best products that fit my needs, and I'm going to absolutely find, hopefully, an institution that I feel like I can partner with to get me where I want to be.
Right.
And that to me is the biggest deal. And then lastly, I'm going to look at cost, which would be that interest rate. What is it going to cost me? And I'm going to have to evaluate everything on a scale to say, does this banker over here that's taking the time to get to know me and my goals and aspirations, does 0.1% interest rate really mean, does it mean that much to me that I'm going to go over here to the person who's cold and dry and not very helpful to work with?
Right.
To me, that's a cost of doing business, and I would, do that. Now, everybody's got a breaking point for what, okay, there's a certain point, if they're charging 10% more interest rate, I may go with that cold and dry person, hundreds of dollars over the life of a loan, or thousands even, depending on the size of the loan.
Right.
So, everybody's got a point, and I know when I was lending money, that's always, because, I think every bank probably says this, but they're never going to be the lowest priced bank, in the area. And I think every single bank in an area says that same thing. But, it's one of those things, as when I'm selling, if I'm selling to a customer, say, everybody's got a breaking point to say, if we can't get there on the rate because I'm just not allowed to, then you have to determine whether or not you value me as a banker, as an individual, as a person, enough to want to work with me on that. And there's no hard feelings if you choose to go with a better price, because I get it. At the end of the day, everybody's working for a living,
right.
Well,
I remember something you told me a while back that it's like I kind of knew, but it was good to hear the reminder, is that, if your loan is for a shorter amount of period, then the difference in interest rate is not that big of a deal. Mm-hmm. Even, sometimes 1 point or two, if you're talking about a 12-month loan or a 2-year loan, it's really not going to make that big of a difference. I know sometimes people will get wrapped around the axle on the interest rate.
Yep.
And I like what you said too about the idea of the banker you're working with, that person's personality, their desire to help you, how you interact with them is just as important, because it really is, like you said, a partnership. And that's the way I try to approach my business. It's not like I'm not here just to try to get money from people. It is hopefully a partnership where, in my case, I'm going to provide something that is going to be of benefit to them, and in the long run. And so it's a partnership. It's a win-win. And it's the same thing with the bank. Again, like I say, I'm calling you because you're the banker that I've talked to before. We have a good relationship, and that goes a long way over a couple of percentage points, especially when you're only talking about maybe a 2-year loan. It's not that big.
Exactly. And that's one of the biggest things to look at is what does that and that's where it's a good point for you to bring up, because to talk about different types of collateral, you've got, and we'll talk about this a little bit more in that fifth C, but the types of collateral that you have allow for different durations of financing. Mm-hmm. And those durations of financing can significantly impact your payment, yes, your monthly payment, but also the amount of the total cost of that loan to you. And so, it's very important, to ask your banker to run it down to say, what if I got an interest rate of 6% versus 5%, or, 7% versus, 4%, whatever it is, what's the total cost to me? Right. Those are important things to know, because while that monthly payment, may not look like a whole lot different, if you're financing it for a really long period of time, then it can end up, making a lot of right. long-term impact.
Well, and I think that's the ticket, is to do the math, or mm-hmm. get the loan, the loan officer, who you're working with, the banker, to do the math and say, show me the difference between mm-hmm. 2 years at, I'm just throwing numbers out, 2 years at 6% or mm-hmm. 4 years at 7%. What's the difference going to be? Here's the difference in my monthly payment. And they might not only be off by like $30-$40, depending on how big the loan is, yep. but okay, what's it going to cost me in the long run? And you go, well, the 2 year at 6 is going to be this, and the 4 year at 7 is going to be this. To me, that's a bigger eye opener to go, okay, is it worth whatever that amount is for me to get this thing now? And sometimes it will be, and sometimes it won't be. That becomes a business decision for the business owner to make.
It does, and any banker should respect that. I'll just be honest with you. Any banker who can't respect somebody's decision on that, is probably not one you want to be with. I know for me, at the end of the day, when I looked at it, to say, look, you are in business to be profitable, and if this dollar amount is a breaking point for you, then, I'm terribly sorry, yeah. Because maybe I just can't get there.
Right.
Right. It's not the case, because every bank is going to have their requirements for the minimum interest rates and maximum interest rates, and there's a lot of stuff that comes into, related to fair lending and all that kind of stuff, and it gets to be, they've got to, every bank should be treating everybody fairly. Right. That is legitimately the case. Long gone are the days. I say not long gone. I think most banks make a very, very good conscientious effort to not be, favorably lending to certain people. They should be complying with those fair lending regulations. And just because it's just the right thing to do, that's kind of where I came down to, just boil it down right down to
just the right thing to do.
Just the right thing to do. It is that if, you've got two borrowers that are identical on paper, that's no reason to be, any kind of discriminatory, but that's, different topic. And so the fourth C that we're going to talk a little bit about is capital. Capital, this is a little bit different than cash flow, okay? Because what we're going to be looking at here is things more like savings accounts, or savings accounts are a great deal, cash value life insurance, marketable securities. Banks are going to request what's called a personal financial statement. They're going to want to see, when you take all the assets that this individual owns, what do they have that they can, in the event of a shortfall of cash, what do they have access to supplement that payment in that time period in which, the business is having a little bit of a downturn.
Right.
Can they support, 6 months, a year of payments on just cash reserves if business is running thin? Right. That is going to be a big deal. Not to say, they're going to look at the cash flow of the individual as well. They're going to look at those other sources of income, but they're also going to say, well, let's just say somebody gets hit in a car wreck and is out of work, or, gets hit by a car or something like that, is out of work for a period of time. Well, as terrible of a life circumstances that is, it happens. I always told my borrowers, what do we have in the event that life happens?
Right. Right.
In the event that life happens, what are you planning for? Right. And to do that, and it's not always easy. I get it, especially in times even like with a epidemic like we've got right now, having a lot of cash reserves may not be on everybody's plate, and it's just one of those things that if you've been out of work, if you're, I was thinking about this, the lady who trims my beard, my barber,
Right.
There was a period of time where she was totally out of work.
Yeah. Yeah. For a few months. Yeah.
Yeah. And that, and you can tell I haven't been to see her lately because I look at more of but, it's one of those things, just kind of thinking through it, it's like those kind of situations that it happens. You never know. We turned the corner on 2020, expecting it to be an awesome year.
Best year ever.
Yeah, and what we've got is a year of growth. This is personal growth for a lot of people and growth for businesses. And, we've done some things this year that in the banking world I never expected to see, with the government guaranteed, the SBA being involved with the PPP loans and all that stuff. And I've seen some really good things, some really, got to experience, be a part of some really heartwarming situations in which, man, some people got to keep their jobs because, we took care of them. And that's kind of a great deal. But at the end of the day, there's never any guarantees.
Right. Right. So what is the primary difference between collateral and capital?
Okay.
In some ways, they sound similar.
Yes.
But does it have to do with how they're tied to the loan?
Yeah.
Like collateral. Go ahead. Yeah, you explain it.
No, you're exactly right. It is exactly how they're tied to the loan. The capital is more of a feel good. Okay. The capital is more of a okay, good. This is a feel good thing for the bank to say that, hey, we do have adequate cash reserves or something over here that could be used in a very rare situation, that if somebody's got the character, they've demonstrated the character, but they've also, they've got a great credit score, they've got no delinquencies and all that, but then they've also got the capital over here where maybe they're a little bit thin on the collateral. Maybe the collateral is a little bit more thin, but they've got a proven history of repaying, their debts. Well, they've also got the capital on hand for when things aren't perfect, they can come up with the funds, and their character is the demonstrator of their capacity.
And I've seen people do that, especially young people or people who have had financial troubles in the past, to begin to rebuild their credit by getting putting $1,000 in a savings account and getting $1,000 loan that is that the savings account guarantees. They still make payments, on that, but it's a way of getting the loan because you have that capital reserved for the just in case, and they're able to get a loan where they maybe had no credit. I know a guy right now, I think he's 18 years old, maybe 17. I think he's 18 years old, but he just did that. They gave him like $1,000 car loan on his clunky old car that probably isn't worth $1,000, but he put $1,000 in a bank account. So he has a collateral of the car, and he has a capital in the savings account that.
In that situation, that savings account also can double as collateral for the loan. It can be both capital and collateral. There is some crossover, or there can be some crossover there, depending on the instance. But yeah, that capital. The other thing too, it's like if you've got, say, like a large like cash value life insurance. Say you've been paying cash value life insurance, and it's got a balance of $7,000 on it, because you've been paying for it. It's a term life insurance, or it's a whole life insurance policy that has a cash value. Maybe a grandparent started it or something like that, and it's been going on for 30 years. Those can accumulate funds quickly, and that provides a borrower with the capacity there to have access to capital.
Right.
They can access that money in the event of a really bad situation. While they don't want to, or they may not desire that deal, they have that option or availability of funds.
Right.
And sometimes like you said about the savings account, sometimes a bank will request that you apply that as collateral for a loan.
Right.
Not necessarily that it just be out there as a feel good. Sometimes they may say, okay, we're going to need more.
You need to lock it down.
Exactly.
Right.
Exactly.
Okay.
And that's where, that's where the biggest deal about that capital comes into play.
Right.
Is, really kind of has more to do with liquidity. How liquid are you in the event that things get thin? Can you come up with the payment?
Right. Okay.
And so next and final C to cover today is going to be the conditions. What are the conditions of the loan? And now that is going to be, conditions is probably the most vague sounding one. So, what are the conditions of the loan? The bank is going to want to know how you intend to use the money that they're providing to you. The bank is going to want to know what you're going to do with the money they're going to loan to you. Is it buying a work vehicle? Is it going to be to buy equipment, buy tools, whatever it is? And a lot of times those conditions, hold on, let me step back real quick. So it is partially based on what you're going to be using the funds for, but also tied back into the collateral to say, how can we structure this loan for repayment? How do you want to? What can you afford? And those kind of things. And all those things get considered. And I say this, these 5 C's, they all interplay so much, is that they're all so tightly bound together, and it can be a little bit confusing and get lost in them. But when we're talking about those conditions, I mentioned earlier talking about real estate is that you can finance real estate a lot longer than you can finance a vehicle. A vehicle typically is going to have a maximum of 60 or 72 month term. And if you've got an older vehicle, depending on the age, maybe 48, 36, or 24 months that a bank will be willing to lend on it, regardless of if you've got it totally paid for or not. That's just going to kind of be the deal, because vehicles lose value over time. The more, mile markers you hit on those things, you're reducing the value. Unfortunately, that's just the nature of it, but typically land and real estate holdings don't decrease over time. You have to basically work with your banker to establish some conditions that allow you to be able to have the capacity to pay the loan. So if a $100,000 loan can't be repaid over 2 years, if that's not an option for you, that'd be a big monthly payment. You may be more inclined to look at holding real estate, applying real estate as your collateral so that you could finance that over a longer period of time for a monthly payment that is going to be more conducive to your success as a business owner.
Right.
And that's a lot of times where that capacity comes in, is do you have the ability to repay this based on the conditions set?
Right.
So
okay. That's good.
Yeah. I know there's a lot of interplay in it, and it's it can be confusing. It's confusing to me at times too, thinking about it, but that's where, the lender that you're hopefully working with will help you come up with the best solution to fit your needs.
Right.
So, in the bank. Go ahead.
Considering all this, what advice would you give to business owners? Let's say they're new. I don't know how they're in their first year of business, and they're seeing some good growth, and they're thinking they're going to need to buy some significant equipment, maybe another truck, or maybe a utility trailer, or something like that, and that they're wanting to. What's the best things that they can do to either? I mean, I know you can't say that they will or won't qualify, but put themselves in the best position, or I guess we can look at it 2 ways: the best position to qualify now, or to potentially get a loan, or to prepare themselves for the future. What's the best thing business owners can do?
Yeah, the best thing they can do is make sure that they've got, good bookkeeping, like we talked about earlier, so that they can demonstrate that they've got that capacity to repay the debt. Make sure that they've got a good credit score. If they've taken care of that, their credit report looks good and all that. And realistically, the best way to go about doing it is, and fortunately, a lot of times when we're talking about buying new equipment or a new vehicle or something like that, that oftentimes can serve as the collateral. That stuff that's being bought is your collateral. So you've already got one thing there, but then also too, when it comes to the capital portion of it, is having the ability to provide some kind of money down, so that they can get that to the appropriate loan to value that the bank can be willing to lend to. That's the other part of capital that I didn't talk about. But being able to ensure that they are able to put some cash into the project they're looking at doing. Right. And so really, cash is the thing. I was in a this was several years ago. I was in a underwriting meeting talking about this, and the gentleman who was presenting, so I can't take credit for this, but the gentleman who was presenting was talking about the economic crisis that took place in '07, '08, '09. That the builders that made it out of the recession were those that had cash.
Mm.
That when things went down, those that could essentially supplement their loan payments, not from the revenues necessarily that they were generating, but that they had a substantial enough amount of cash to be able to supplement the income as business was going way down. They could still maintain their loans. If you can keep paying on those loans, then they will, you can get out of it. You can get out of a downturn in the economic cycle if you have cash. And the builders that made it through were the ones that had the cash on hand to do that, and the ones that didn't were the ones who were overextended and undercapitalized.
Right.
And filed bankruptcy and, had foreclosures on all their stuff, and it just, got ugly real fast.
Got ugly real fast.
Yeah. I mean, it did, and it's sad because there were a lot of that, it doesn't just put the business owner out of work. It puts out the fire of all the employees that they have as well, and that's tough. It creates hardships on families, and no banker wants to be that person, and if they do, they're, bad.
Well, I had a friend, I mentioned this to you before the call. So I had a friend who's a business owner, and he's new into business, and he said he went and looked at one of the online lender providers or whatever, and they wanted him to be in business, I think it was at least 2 years, and be bringing in like $8,000 worth of revenue every month before they would even consider him. So that's an example of I don't know, you may or may not know, but I suspect that bank is operating off of a company policy that says this is how far down we'll go in lending as far as risk goes. But because you look something up like that online with a legitimate lending company, doesn't mean that that's always the case for every bank, right?
It definitely does, and I will tell you that as far as industry standard goes, you're going to be looking typically at a 2 year of business, being in business for 2 years,
right.
Because that tells you, most businesses that are not going to be successful,
right,
they will go out of business within the first 24 months.
Right.
That's.
But I think that also takes into account if the loan is completely dependent upon the business. Now, if you bring in other things like personal capital or collateral, or even something like taking out a second mortgage on your home or something like that, then that makes that not as like certain, right? That it has to be 2 years. Is that true, or is that not true?
Right. Yeah, yes and no. So it may have an issue that there may be an issue with how that loan is classified as to whether or not that is technically a loan to an individual person versus, and we're getting into some regulation stuff there and talking about exactly how that breaks out, because those regulations require disclosures that, it just triggers a whole myriad of headache, just
right.
in general.
But that's one of those things a banker can, again, you go and talk to them and they can help you. I guess a banker could say, hey, if you want to take, we can't loan your business, but we can look at your personal finances. And if you want to take out a personal loan, pay for, this trailer that you need or whatever, then that might be possible, and we can investigate that.
It is, exactly. And that's where you have to kind of get into some brainstorming sessions, with the lender and a banker to hopefully help you kind of see some of the different options that their financial institution is willing to do related to some of those things. So you're absolutely right. And every bank is going to have different policies for what they allow and like you said, how they handle that risk associated with it.
Right.
So.
Do you have any last question that I have, unless you have anything else? But I was going to ask, do you have a story you could share about a business? I didn't ask you this question beforehand to give you time to think about it, but just like a person that or a business that that is a success story of how they got the lending they needed and this is what it did for them or whatever. I wondered if anything.
Yeah, absolutely. I know there have been times in which I had taken over a whole bunch of customers when I had changed my employer, and through the process of getting to know my existing customer base, I had realized, just because I tend to think a little bit differently than some other people do, and other people think differently than I do, and all kinds of creative deal. But I had figured out that one of my customers he had all these loans that were at really rapid repayments with I say really rapid repayments. They were really large payments. And what we were able to do is we were able to actually consolidate all of those loans with one single payoff request, utilizing his personal residence, and that allowed him to essentially he more than halved his monthly payment because of the way we structured it. It just gave him a better option for the financing, and man, I'll tell you, that's a huge deal. And for this customer coming up on paying for daughter's wedding, and had a large need, and this allowed him to essentially utilize that equity in his home to fund, not only to pay off the other loans, decrease his payment, but also allowed him to fund that daughter's wedding through that equity that he had built up over a long period of time living in his home. And, it just ended up being a win-win for everybody because, at my current employer where I am, every bank is going to have they're going to have some niche consumer products they had. And I mentioned that earlier. My current employer, I think, has one of the best home equity line of credits in our competition area. I love that product. Think it's a phenomenal product, the way we have it set up, whereas maybe we're not as competitive on other things or have a niche carved out for, say, like auto loans or something like that. A previous bank that I used to work for had a niche product specifically for home improvement loans. That it really is a great product. And now that they don't look a whole lot different regarding any other kind of loans except for that one, and that's coming back to the shopping around, is that, yeah, absolutely, go shop around, because you may have a specific need or something like that. They may not, that first bank you go to will have a product for.
Right.
And so we're maybe not even the best product. Every bank's, we're all kind of working with the same toolbox here.
Right.
We're all kind of very similar toolbox, but some of us have slightly different or better tools, if you will, in certain regards. And so with this product that we had, the home equity line of credit it just kind of shocked him and blew his mind as to how much money we could save him and provide so much flexibility with his payments and how he wanted to utilize those funds. And it was because he had, a really solid piece of collateral. And
right. Yeah.
Additionally, he could pay it back.
Yeah.
But
that's cool. That's cool. Well, hey, Zach, I appreciate your time. I appreciate the school lesson through lending and understanding better, because I think that's what causes so much frustration, is that people, they know, in their mind, they've got this vision of themselves that, like, I'm a trustworthy person. I've always handled my money well and things like that. But in a bank telling you no may be completely out of their hands if it's a regulatory matter, or even if there's a policy matter. If it's a bank, you may not be able to get around that policy in any kind of short order. And so it's not a personal thing. It's just a kind of a numbers game and a policy regulation thing that really drives a lot of it. I think that's pretty helpful, because people have this vision and they want to go achieve it. And, someone telling them no is like, well, what, you don't believe in me? I believe in me.
I know. and it is hard. It can be hard, a lot of times, like, coming back to the time frame just real quick, coming back to that length of time in business, that is a lot of times where SBA comes into play. The SBA, government program,
right.
With government guarantees, can allow banks to do that if that bank has a good government guaranteed lending program.
Right. So the SBA programs or help, how do you connect with that? Do you connect with that through the bank, or do you contact an SBA office separately? How does that work?
Okay, so a lot of times, like I know, some universities are participants with, they will have a,
yeah. Well, we had one when I had my pool cleaning business when I lived in Texas.
Yeah.
There was a local SBA office at the university, and they held training and classes. You could become a member, but you didn't have to, and a bunch of other stuff.
Mhm.
And they were super helpful on a wide variety of things.
Yep.
Um,
So yeah, exactly like that. I know in the Russellville area, Arkansas Tech has one. It's their Arkansas Small Business Technology Development Center, I think is what it is, the ASBTDC. So many acronyms.
yeah, yeah, I
But
know.
yes, exactly. But yeah, they do the same kind of deal. They help with doing business plans. For to push out pro formas. Based on anticipated earnings and that kind of deal. And they walk you through it. They will literally, take you step by step through the application process. A lot of times they will reach out to. I mean, they can't refer you to bankers or any. I don't think they can do anything like that. But
Right.
in basically handing out a list to all the local banks, they can say, okay, well, this is what you'll need to take to them,
Right.
and in that, and they can walk you through that, and you can give them permission, to for the banker to contact the person that worked with them and that kind of deal, and it really does create a good good conversation with
Right.
the bank if you come in prepared. It definitely makes it easier.
Starts off on the right foot.
Exactly.
It's
It
kind of like
does. It does.
if you ever watch Shark Tank, the number one thing that they always get frustrated about is when people don't know their numbers. Right? You
Yep.
come in here and you want money from us as sharks, and you
Yep.
don't even know your close rate or your customer
Yep.
acquisition cost, or you don't
Yep.
know, what if how much of a percentage is your gross versus your net. You just like if you don't know those numbers, you
Yep.
need to know them as a business owner.
Really do. And that's what, bankers can't be nearly that harsh because they're,
Oh
not
yeah,
sharp.
yeah, yeah, yeah.
But,
But
but
it's
no, you're
important to start off on the right foot, I think. And my experience with the SBA been has always been really, really good. You talk about an organization that's out for you as a small business owner to do well. The SBA is definitely it.
yeah, and it provides, great incentive for banks to work with the SBA, to have an SBA portfolio. It shows that you are lending to an say like an underserved area, but an area that is, that they normally couldn't loan money to, and it
Right.
does provide a economic community boost, and that's the biggest deal is they want banks being involved in the communities, and
Right.
so
Awesome. Well, Zach, again, let me say thank you. I would say to anyone who's listening or watching this if you have other banking questions, I'm not saying Zach's going to monitor them all, but if you have other banking, financing with regards to business questions, post them in the comments below, and we'll have another episode. We'll have either Zach on again, or we'll find somebody else or whatever to talk about some of those things and see how we can keep giving you good information to help you make your business the best that it can be.